Wall Street veteran Jordy Visser is one of the leading voices on AI, Bitcoin, and the future of investing.
So there's been a huge gap between the CEOs of companies loving AI and paying Anthropic lots of money, and then the employees using it. There's been a huge gap. So the surveys all say the same. Like, CEOs all love it and say it's going to change their business. Employees aren't so excited. Now, I'm not sure it's just because it's going to take their jobs. I actually think they don't know how to use it. Now, if you have 100 employees in a department and 2 of them are power users, meaning they love it and they're figuring ways to do it, so people understand what loops are. The agents are figuring stuff out on their own, but they do need the human context and they need to learn everything going on in the business. So if you're in a marketing area of Coca-Cola and there's 100 employees and 2 of them are using Claude in a really, really good way, and the agentic loops are being used by those 2 people, and the other 98 are doing something similar, then these people are training their replacements at this point. That's the thing that we're entering into this dangerous point. And this is where the job losses could come much faster. And that's where Anthropic's revenue gains, to me, are going to have to come from. The total compensation and everything that happens in this country is about $20 trillion a year. If you can get rid of a bunch of employees, and right now, so people remember, we are not creating jobs. So yes, the last 2 months, we created a couple 100,000 or 300,000. Most of them were in the healthcare side. But over the course of the last year, there's almost been no job creation. The reason that matters is because in the history of this market, the way that we got more nominal GDP was you get more employees every single year. And then in recessions, you don't hire people, you fire them, and it goes down. We are growing rapidly without hiring people. So that means the profits are going into the companies because they're actually not firing people at this point. They're just not hiring them. If they get to the point that the loops are there, and this is why people need to pay attention, the agentic loops are not only important for the businesses, but they start to become important for the commerce side because it means people are learning how you're doing stuff on your computer. And then as a
what if Bitcoin isn't crashing because it's weak, but because Wall Street is playing a completely different game than most investors realize? What if Bitcoin's latest drop has almost nothing to do with Bitcoin itself? That's the argument emerging from this market discussion, and it completely changes the way you look at the recent sell-off. Instead of blaming weak demand or fading interest in crypto, the focus shifts to a much larger story unfolding across global markets. For months, Bitcoin traded alongside gold and silver as investors searched for protection against inflation, soaring government debt, and the declining purchasing power of fiat currencies. But when expectations for higher interest rates returned and the US dollar strengthened, that entire strategy began to unravel. Suddenly, institutions weren't abandoning Bitcoin's future. They were simply reducing exposure across the entire debasement trade. That distinction matters because today's Bitcoin market is no longer dominated by retail speculation. Institutional investors now make allocation decisions based on quarterly portfolio targets, macroeconomic conditions, and risk management. As a result, Bitcoin can experience sharp corrections even when its long-term fundamentals remain intact. The bigger question is what happens next. If structural issues like expanding fiscal deficits, rising sovereign debt, and accelerating AI-driven economic transformation continue to reshape the global financial system, demand for scarce digital assets could return with even greater force. In that context, today's volatility may represent a temporary reset rather than the end of Bitcoin's long-term trajectory. Do you believe this is just a temporary shakeout, or is Bitcoin entering a new phase? Share your thoughts in the comments below, and let's discuss. If you enjoyed this breakdown, don't forget to like, share, and subscribe for more in-depth crypto and market analysis every week.
Institutions, for the most part, they're the older you are, the more you think it's a bubble. Nobody who thinks AI is a bubble thought gold was a bubble. Gold was the way bears got to come out and go, I'm bullish on something, it's just gold. They're also all bearish on bonds. Nobody owns bonds. Why would you own bonds? Like, inflation's on the higher side. So the debasement trade is not just long gold, long silver, long Bitcoin. And yes, Bitcoin was part of it until October of last year. Bitcoin was outperforming the stock market. Bitcoin was outperforming bonds significantly. So gold, silver, and Bitcoin get lumped in. It's amazing how Bitcoin gets lumped into software. We get a bear market in that. It gets left basement trades washing out. You got gold and silver going down because Kevin Warsh came out and said, well, I think I'm going to be more hawkish. And everyone said, that's it. Dollar rallies, everything's good. And I'm like, we still have a deficit. We still have massive debt. Nothing is going to change because he speaks a certain language. And we've got a lot of people. I mean, Warren Pies put out a great chart this week. I was going to send it to you, which just showed the part of the economy that is now the information and computer side versus residential investment. Residential investment is not moving, which means house prices are not moving, which is where the bulk of the Americans would like to see this bull market. AI going up does not benefit everyone the same way. So I think the debasement trade has reached a point. Bitcoin is now an asset that people invest in. It's part of the asset allocation process. People make decisions at the end of a quarter, and you tend to get a lot of people that are bailing out. You also have people shorting the hell out of the thing because I'm reading more Michael Saylor stuff and that MicroStrategy is going to blow up and they're going to have to sell. So we really have the mob is not involved, meaning retail is not involved. It's a bear market. You have institutions that hate Bitcoin. You have the debasement trade going down. You still have the software names like Adobe and Salesforce not bouncing at all. Bitcoin is just lumped in with a bunch of bad stuff right now.
When will it recover?
Again, for me, this is a very simple thing. And I say simple because it's what I do believe in terms of the end game for AI. AI agents and the network effects happening and the amount of volumes that will be going on, the economy will change forever. There are two things that will happen, and I've mentioned this on here at least a few times. When Caitlin Long wrote a piece about the velocity of money changing. Now, this is a TradFi banker who understands GDP, and we both respect Caitlin a lot. She knows that world really well. And so do I. Velocity of money has been a dead thing. And the reason it's been dead is because the world's assets have gone up so much. So when you go through the whole what Bitcoin represents, it represents the fact that the fiat assets have gone up so much, the distribution of wealth has gotten worse, and it makes people angry, and the government just keeps solving this problem. They're not going to need to do that anymore. And the reason they won't need to do that is a combination of demographics. So there is $700+ trillion of wealth on the planet. It's in assets. 2/3 of those assets are in dormant assets.
What if the biggest threat to jobs, markets, and even Bitcoin isn't a crash, but machines that start thinking, learning, and transacting on their own? A major shift is unfolding inside companies, and it may be one of the most important signals for Bitcoin's long-term trajectory. The concept of agentic loops suggests AI is no longer just a tool, but a system capable of learning, adapting, and executing workflows with minimal human input. But the real question is, what happens when only a small group inside companies actually knows how to use it? According to this view, a dangerous gap is already forming. CEOs are highly bullish on AI and expect massive productivity gains, yet most employees still struggle to integrate it into daily work. That imbalance creates a powerful dynamic where early AI adopters become exponentially more productive, while others fall behind. Could this be the beginning of silent job displacement without mass layoffs? As AI agents begin to handle transactions and automate business processes, the velocity of money across the economy could rise sharply. Combined with tokenization, this reduces friction, cuts out middlemen, and reshapes how value flows through financial systems. And here's the bigger question. If machines start transacting, optimizing, and learning at scale, does Bitcoin become just another asset, or does it evolve into a core layer of this new automated economy?
The older you are, the more you think it's a bubble. Nobody who thinks AI is a bubble thought gold was a bubble. Gold was the way bears got to come out and go, I'm bullish on something, it's just gold. They're also all bearish on bonds. Nobody owns bonds. Why would you own bonds? Like, inflation's on the higher side. So the debasement trade is not just long gold, long silver, long Bitcoin. And yes, Bitcoin was part of it until October of last year. Bitcoin was outperforming the stock market. Bitcoin was outperforming bonds significantly. So gold, silver, and Bitcoin get lumped in. It's amazing how Bitcoin gets lumped into software. We get a bear market in that. It gets left agents transacting a lot. The velocity of money is going to increase significantly. And when the velocity of money goes through, people have to realize that GDP at the end of the day is a total sum of transactions. And transactions are going to be happening faster. And the pieces of the pie that make up public companies are middlemen. They're taking taxes on all of this stuff. And so there'll be less taxes in terms of the friction that goes on. And every year it'll get less and less. So I've always believed that the third wave of crypto, which in Elliott wave terms means the most explosive one, would happen when the agents came. And I just want to leave people with one other part of Elliott wave. If I'm right about that, and I believe AI is the durable part. So for those of you who are bearish AI, where Bitcoin is gone to me is if AI collapses, which to me is not going to happen. AI is a real thing. It's going to keep moving forward. AI agents are a real thing, and we'll just keep making progress.
If AI agents are starting to make decisions, execute tasks, and eventually transact on their own, what happens to a financial system built around human delay? And if tokenization keeps removing friction from markets, how long before money itself starts moving at machine speed? In that world, Bitcoin stops being just a speculative asset on a chart. It starts to look like a layer inside a much larger system, one where value is stored, transferred, and verified in real time across automated networks. But here's the uncomfortable question. Is the market pricing in this shift at all? Short-term volatility may still dominate headlines, but underneath it, a deeper transition is forming. Capital is moving faster. Intermediaries are shrinking and AI-driven coordination is accelerating. So the real debate isn't whether Bitcoin survives the next cycle. It's whether traditional finance can adapt quickly enough to a world that no longer waits for it. If this shift is really unfolding beneath the surface, the real question is, are you positioned for what comes next or still looking at yesterday's market? Share your thoughts in the comment below. And don't forget to like, share, and subscribe for more deep dive crypto analysis. Is Bitcoin entering its most powerful phase or just another macro-driven cycle?